With that, we do have an awesome guest speaker who is here with us today. We have Jeff Cohen, who is a senior vice president at Zywave, and he is also a very super duper awesome Spencer board member. So we're super happy to have him here with us today. So thank you for being here today, Jeff, and I will turn it over to you.
Absolutely. Tandeka, thank you so much. Welcome to all of you. It's great to see you all. I imagine at some point Tandeka is going to ask you all to smile for some group photo. But until we get to that point, let me say it is a pleasure to talk to people who are interested in learning more about insurance and why I believe this is such a great industry. Um, my plan here is to tell you a little bit about me, perhaps also my role on the Spencer Board of Directors. I have a few slides that I want to share with you, mostly to keep me on track and distill my favorite points about what the insurance industry is all about and how it fares relative to other insurance spaces. And I also want to give you a little bit about my background and how I came to be sitting in my New York City apartment at age 60 and talking to all of you fine people. So we'll cover some of that as well. Tandeka is going to watch the chat, and if there's a question or something that you have, file it through, and I'll do my best to either get it in the middle or address it at the end, and we'll go from there. And yes, I'm all about building connections and establishing another, block on my network. So welcome the LinkedIn approaches and all the other ways that you think you can derive value from these comments. So let me begin by telling you a bit about me. Um, I grew up in Maryland. I went to school in upstate New York. That's where I met my girlfriend, who's now my spouse, in college, and we moved to the New York City metro area. And I've been in New York City ever since. So that's 1987 to now, which is probably before several of you were born. And I started working at this little company. It was a startup with less than 100 people. That was Bloomberg Financial Markets, started by Mike Bloomberg, and absolutely through luck. And I lasted about 15 years. He left to become mayor in 2001. And I became perhaps a little disenchanted with the way the firm was running in his absence. And I caught up with a bunch of people who were creating what I was led to believe was a Bloomberg for the commercial insurance space in 2003. And as it turns out, that was absolutely not what we were doing. But we did develop a couple of really interesting data assets that we were selling to carriers and brokers. And I stayed at Advisen for about 17 years until we sold the business to the company that I work for today, which is Zywave. And Zywave is about 1,000 people worldwide. Figure about $250 million in revenue, so 250 million or so. And we create data sets and content and offerings, all designed to help insurance write more business more profitably and to help insurance brokers and agents sell more insurance and become better at it. In so many ways, I will tell you that we are all about making insurance market participants more capable, more efficient. And yet at the same time, I will tell you that everything I'm telling you about insurance, I learned from talking to customers and prospects of our companies, not because I was an underwriter or a broker. I will tell you as well that I'm enamored enough with this business that I can't imagine doing anything else. And you'll see why in just a moment. With regard to my affiliation with Spencer, I joined the Spencer Board of Directors in 2018, and I was looking for a way to give back. I've been fortunate enough to have some amazing positive experiences in this space, wonderful client relationships, and I'm a big proponent of philanthropy and ways to sort of capitalize on all the good fortune that I've had, which principally for me becomes How do I help the next person get to where I am, but to do it a little faster than it took me? Um, in much the same way, I have we have twins. They're now 29 years old. But as a parent, my approach has always been, look, you know, you don't have to be amazing. You just have to be better than me, and I will help you. Perhaps it's not the highest bar. So let me help you get to that spot. And that's how I was a biology major in college. So I still think about it, perpetuating the gene pool. This is all about how do you make people better. An awful lot of insurance is still learning via prior experiences, and that's going to come through in some of our remarks about losses and what the industry is all about when it comes to thinking about frequency and severity. But this is all about how do you not only learn from others' mistakes, how do you take that and transpose it? And one of my, main talking points that I hope you take away from this conversation is that insurance is one of the few industries out there which is actually trying to make the world a better, safer place. And the way you do that is by leveraging technology and advances and all sorts of protocols to say, wait a minute, this might not work out the way we had intended. Let's reevaluate. Let's assess. Let's look for a better, safer, healthier way for this to happen. And in that basis, I love being affiliated with an industry which is all about trying to figure out how do we make money while we are making the world a better, safer place. All right. So I'm going to begin by showing you a New Yorker cartoon. I pulled this one from a year and a half or so ago. I'm not worrying, I'm warding off tragedies by constantly anticipating them. And if you think about um, all of your interactions with your parents, with your teachers and your mentors. There are people that we are associated with, affiliated with in life who have gone through these experiences ahead of us. And I'm not suggesting that they all know better. I'm simply suggesting that um, the value of experience is large. And when it comes to insurance, um, the value of experience is large, perhaps larger than anything else. And insurance is this aspect of pooling risk and making sure that if something adverse happens, we're able to repair, restore, replace, help that entity get back on their proverbial feet. So I've just sort of distilled the 10 areas that I want to go in this conversation. Along the way, if something strikes you or you want to ask and drill down, let's go there. But I'll begin by telling you about insurance evolution as I see it. Um, the human experience is all about challenging the status quo. And what I mean by that is humans have this penchant for wanting to do more. you know, from the very first days that, humankind discovered fire or the wheel or some major invention, how do we make this better? All the way to sending people into outer space and exploring whether or not there's life on other planets. The human experience is all about more. And as a result, boundaries get pushed. And insurance comes along and says, okay, if this is going to happen at a certain pace, how do we protect, how do we serve this process by being able to backstop it if something goes wrong? Um, I will tell you now, as a 60-year-old, that I think that human beings are remarkably creative at getting into trouble. But part of that trouble, not that different from what John Lewis in Congress said, is all about good trouble. And here what I'm referring to is this idea of how do we advance ourselves? How do we push to achieve something that hasn't been done before? How do we make some new product or new invention, come up with a new process? How do we deliver goods from point A to point B in as fast a time frame as possible? All of these things are challenging the status quo. And insurance is the backstop by which these processes get protected. So think of any new endeavor, think of any new thing that's happened in the last several hundred years, and I will stipulate that there was a role that insurance played in protecting the outcome so that it wasn't a complete disaster. And look, there are definitely outcomes that all of us would agree are problematic. But the fact of the matter is that insurance steps in to make it less so. And that takes me to this concept of what I'll refer to as frequency and severity. And just to level set, because I think this sort of injects these two terms inject themselves in every conversation that you have about risk. Frequency is how common, how actively, how much time, how when do these bad things occur? Severity is how bad are they when they happen? All of you have to be thinking about frequency and severity as you pursue your careers in insurance because there are things that we'll call low frequency, high severity. They don't happen that often, but when they happen, they're crippling. Versus other things which are high frequency and low severity. High frequency meaning they happen sort of all the time. Low severity meaning not so bad when it happens. And the industry will talk about slip and falls and fender benders in this mindset when we're talking about high frequency, low severity. I have a fleet of 1,000 trucks. All of my truck drivers get out every day, and inevitably, they have a few nicks and a few this and a few that and a few fender benders, and things happen somewhat like clockwork. If you have 1,000 anything, something's going to go wrong periodically, and when it does, that's a problem that we have to fix. That problem that we have to fix becomes the severity. How often it happens is the frequency. There are a bunch of people sitting in chairs. Somebody is going to have some ergonomic strain. Somebody is going to slip. Somebody's going to fall. These are all things that humans do in the context of work. It happens. Low frequency, high severity becomes one of the biggest problems in the sense that companies, particularly companies, and I would also argue households, work off of a budget. This is what we expect to happen. And these are the boundaries by which that expectation can manifest itself. But lo and behold, we had a catastrophic event occur. In the case of a company, it could have been a giant lawsuit or some sort of claim, product liability problem. In the case of a household, a car rendered inoperable or a fire. Low frequency, high severity things cripple balance sheets and throw off budgets. And in that case, the only thing that can really step in to repair, restore, replace becomes insurance. Short of that, your factory burned down the ground and we're sorry. With insurance, particularly if you have a insurance policy that stipulates replacement costs, okay, it's a setback, no question. Your business will go through a rather significant hiccup, but your business will live to fight another day. And that takes me to this notion of casualty versus property. And then I'm including cyber, and I'll tell you why. The world is, of course, divided into risks if you're looking at things from an insurance lens. Casualty meaning things that humans do pretty much in the context of going about their daily rounds and chores. Property meaning things that happen to the things that you can own, your factories and your trucks and all of your stuff. Cyber is really the next frontier because it's things that happen to your data. And I would suggest to all of you that we are all walking around addicted to our various devices and our supercomputers and our laptops and more we have a whole treasure trove of data that defines each one of us, from pictures and passwords and all sorts of material that's It's stored on our computers, online, in some cloud, whatever it might be. And businesses are no different. And I'm definitely talking to you from a perspective that says in the future, businesses and households will have to protect things in three categories. One category will be all the things related to people. I'm calling that casualty. All the things related to property, all the things related to stuff, and then all things related to data. And I think the world is trending in that direction. Hasn't happened perfectly yet, but it's obviously moving. And cyber risk and the marketplace for cyber risk is certainly projected to be, a multi-billion-dollar premium marketplace. And that's because so many companies, mine absolutely included, are companies that transact quite heavily in the context of data. Um, let's move next to risk pooling and why do businesses buy insurance? And maybe I'll throw it out to all of you to come up with a fast response. Why do businesses buy insurance? What are you thinking about as I'm blathering on at you? And I'm just trying to make you smile when I say that.
To
Answer.
protect.
Go
Okay.
ahead. Yeah, Stefanos.
Yeah, I think when I hear the word insurance, I immediately think protection. Like that's the number one reason why people get insurance. And I also think of kind of avoidance, where there's a problem. Maybe it's a persistent problem. Maybe it's like criminality, for example, and it's unpredictable. So you might as well just get protected instead of trying to beef up your security. Buy some insurance, and then eventually, if it does happen, like maybe if you're a big firm, maybe there's a crime every 6 months. You're protected from it. So
Uh, that's a good answer. I like that. And there are parts of it I'm going to come back to in just a moment. Give me one other alternative to Stefanos' response. Somebody else. Why do businesses buy insurance? I absolutely agree with the notion of protection, 100%.
The company wants to use the fact that if they have, if they pool their risk and use the others, it's gonna be helpful for them. It's just like everybody have participate in a risk, so it's kind of protection.
Yeah, I agree with that comment as well. The fact of the matter is that, if we're building rocket ships to go to the moon, and something happens with my rocket ship, by having insurance, I'm not buying a whole nother rocket ship, but I get a replacement of my rocket ship if something goes wrong. And so risk pooling is really the concept that all of us paying a little bit so that one of us who has a bad outcome can be made whole. And that concept is the essence, in my mind, of why businesses and also households buy insurance. Look, if my family's home burns down to the ground, I don't have the wherewithal to just buy another home. If I did, I would live in a much bigger home. But I can pay a little bit in terms of home insurance so that if something really unpleasant happens, I get a new house. And that works very well. And so, Stefanos, you made a comment that I want to go back now and build off of, right? It's this idea of how much proactive safety measures should I put in place versus just have an insurance policy if something goes wrong. And I would argue that insurance companies actually want to do both, right? And this is going to come up in just a moment when we start talking about how do insurance companies make money, right? It's the essence of I want to bank as much premium as possible, and I want to pay as few claims. In order to pay as few claims, I want to make people safer so they don't have claims. So I want to do both. We're going to drill into that in just a moment. So next question, can a business operate without insurance? I see a bunch of head shaking. Anybody want to argue? Absolutely yes. Why
Yes.
buy insurance? Go ahead. Tell us more about what you're thinking.
Um, it's not impossible to have a business without the insurance, but it's protective. It's reasonable and rational to have insurance and to avoid future risk, but it's possible. And the fact is here, these days I have heard about a captive also.
Uh-huh.
So it's a kind of business. So it's a kind of insurance that business can use it.
So I'm gonna make a couple of remarks about your response, and I believe that a captive is absolutely another form of insurance. The the essence to the premium is just stored in a different way. But be that as it may, let's go back to the Spencer Board of Directors. The Spencer Board, as a business entity, is a operation with 4 or 5 full-time employees, few of whom are represented on this call. Thank you very much. And a board of directors, some 30 of us, plus or minus, who ensure that the mission is adhered to. And I would tell you that that mission is about as straightforward as it can be. We are all about manufacturing more talent in this space. We want more people, more capable individuals pursuing careers in insurance and risk management. That is what we are all about. Singularly, that is the only thing we do. And we accomplish it by awarding scholarships and paying for internships and supporting grants from various colleges and universities to teach some of these principles in the classroom. And we are agnostic when it comes to which individuals or which universities. Everything is done completely based on merit, irregardless of financial need. And that is the business of the Spencer Board of Directors. Having said that, we carry insurance as well, because every now and then something can go wrong. And I would argue that any business, profit, nonprofit, public entity, government, municipal, what have you, cannot really operate without insurance, because you need that protection for the what if. And the most likely what ifs that could happen to your business are the what ifs that have already happened to all the other businesses heretofore. The fact of the matter is that, that next hurricane will blow through some part of the world and it will destroy an awful lot. Mother Nature is hard to control. And when it does, you will always hear the news talk about insured losses versus economic losses. Economic losses, in my mind, are the hardest things to stomach as a news viewer, because what you're watching is disasters that have happened where there is no financial backstop. Those individuals, those households, those companies had no insurance, and it's destroyed, and they won't come back so easily. Versus insured losses, where an insurance company is now on the hook to rebuild, restore, replace, blah, blah, blah. And I would suggest that the bigger the business gets, it's virtually impossible to operate without insurance, partly because your board of directors, just like the board that I serve on, will require, in order for this to happen. If we are a bunch of investors, I don't want to lose my investment, which I could if our factory burns down to the ground. Therefore, I require that you have insurance so that if my investment is not rendered obsolete. So here we go. When is an insurance purchaser most satisfied? You are the policyholder. You buy insurance. When are you happiest in your insurer relationship? I see a couple hands. Stephanos, jump in here.
Yeah, I was gonna say, the happiest I would be if I owned insurance would be when there was disaster, because then I know I'm covered, and that the money that I've paid as a premium is worth it then.
That's an interesting response. Who would like to argue the other side? Any takers?
I would say that it could be right at the beginning because that's when they feel the most security, knowing that they'll be
covered for a period of time. They don't have to worry about anything.
I like that response. I'm going to build off of it. But before I do, anybody else want to chime in with another thought?
I can chime in. I don't think they're happy when a loss happens because that's never a happy situation, right? So like if the house burns down, even if insurance is, covering it, they still have work to do to replace, repair. So I don't think they're happy at the moment of loss.
And when might they be if that's not the moment for you? When might that happy moment in that buyer-provider relationship occur?
When they have a claim and the insurance company pay for the claim, and at the end they will be satisfied.
Yes, your response is similar to Stefano's. Let me argue on the side closer to Travis. Um, and this is perhaps the issue that makes insurance as a business wholly unique from other entities, and there are several others that can be put in this category. I will argue that when your factory burns down to the ground and you filed a claim and the insurance company pays the claim, okay, your business will live to see another day. But that's not when you are happiest. I would argue that you are happiest when you do not use your insurance at all. You are happiest when your business, your household is humming right along and doing everything it does. Now, what that means is you bought a product that you don't want to use in order to be happy, which is sort of ironic because everything else in our lives are things that we buy and we are happy when we use them. I love this car. This car drives fast. Look how fast I can go. I'm happy. This milk is delicious milk. I love this milk. I'm drinking it. I'm consuming it. Insurance strikes me as the opposite. I'm really happy when I'm not using it, which is to say, insurance is a product that is sold with the expectation that you don't want to use it. And I'm buying it with the intended outcome being it's going to sit on the shelf and I'm not going to use it. It's, as one of my favorite retail brokers told me, I sell expensive PDFs and a promise. I don't want my customers to use it. That's what I sell. That's my product. Now, perhaps that's a little tongue in cheek, but the idea, of course, is that as a policyholder, I'm buying something that I don't want to use, which is very counter to almost everything else in our daily lives. By the way, as the provider of that insurance policy, as the insurance carrier, I don't want you to use it either because I make a lot more money when you don't file a claim. I make all the money in terms of the premium that I took in. I made my promise and I kept it, and I don't want you to have a claim. From my standpoint, that's one of the most interesting aspects of this industry versus all other industries. So let's go to my next favorite question that I love to ask people. What economic attribute defines a third world country? I'm just looking for one. There are perhaps several, and you'll make your case. But tell me the economic attribute that defines a third world country rather consistently, one third world country to another. Anybody? Do we see any hands? Any heads nodding?
Stefanos, I think I saw a hand. Paul did type in the chat box, but Paul, I don't know if you're comfortable enough to unmute yourself and say it verbally.
Oh, I was gonna say GDP, overall economic.
So I would argue that there are large third world countries and small third world countries, Paul. And so I'm not sure I see GDP as the defining attribute. And remember, I'm completely biased in having this conversation with you. I see the presence of a um, vibrant insurance market as the defining element. And let me explain what I mean by that. we've covered earlier, as our fictitious board of directors, that we want to have insurance such that if our factory burns to the ground, our investment isn't lost. We file an insurance claim and the insurance company pays for us to rebuild our factory or our oil pipeline or our harbor, whatever, like type of thing. Without a vibrant insurance marketplace in my society, culture, country, I'm left to self-insure. What does self-insure mean? It means that if my factory burns down to the ground, I have to build another factory and pay for it. I'm self-insuring. And I'm familiar with a lot of young people who say, well, I don't need that healthcare coverage. I will self-insure. I'm a healthy person. It's the same concept. If something goes wrong, I will pay for it. I'm going to hope that nothing goes wrong. I will suggest to all of you, and I don't mean to disparage any third world country whatsoever when I say this, I will suggest to all of you that the presence of a vibrant insurance market is that defining characteristic simply because it limits the types of businesses that you can have that are successful and generating all that GDP that Paul alludes to, right? I can only have businesses where replacement cost is manageable by the owner of the business, which is to say, again, not trying to put down any particular vocational pursuit, but the fruit stand, the shoe shine, the store that sells whatever it might be, consumer to consumer. Those businesses are small. The proverbial pizza store that sells pizza by the slice. Something happens to that business as the owner, I might be able to pay for a new one, get a new fruit stand. But if I have a giant factory that makes iPhones or something else, something happens to it because it gets damaged, and perhaps my third world country is subject to more Mother Nature, political violence, terror, or whatever. Once this happens, I'm sort of out of luck. If there is a investment that needs to be made, will I make that investment in a third world country where I have to pay replacement costs if something goes wrong? Or will I make that investment in a second world or first world country where there's a vibrant insurance market such that I'm only paying a fraction of replacement cost as my insurance? And when you compare that, you now say to yourself, well, where am I going to make that investment? Where am I going to build my oil pipeline? I'm going to build my oil pipeline where if something goes wrong, I get a new oil pipeline. And that for me becomes the ceiling, if you will, by which a third world country can't break out of until there's a vibrant insurance marketplace. So let's move to this concept of how insurance companies make money. We've talked already about the idea that insurance companies want to attract all the premium and not pay the claims. How does an insurance company make money, though? What are your thoughts there? The CEO that I work for loves awkward silence, and he'll ask a question on a big Zoom call, and then he'll just sit and wait. I'm a little less
Gladys,
the awkward silence, so I'm glad to see Gladys speaking up.
Right. I think they also invest the money they collect, called it float, in things like stock or bonds, so they can earn additional income.
Yes, I think you're absolutely correct, Gladys. This idea that I'm banking all the premium from all my policyholders, individuals or companies, and while I hold it, I'm going to make money with my money. And by the way, that's an important lesson for all of us. It's not just ourselves as individual contributors to our prosperity. The trick, of course, is to acquire a certain amount of assets and have our assets work for us too. That's double dipping, and that's totally valid. So I totally agree with Gladys. What else? How else do insurance companies make money?
I think I saw Stefanos with a hand up earlier. did you want to say something? Or anyone else, please
I
feel
was
free to
gonna
use
give
the
a
button.
similar. I was gonna give a similar response to the person before, where I was gonna say that they usually invest the money so it's not sitting around, so they can actually make money. But if I had to give a unique answer, I guess another way insurance companies make money is by making society safer, by giving advice on how to make businesses or places in general safer so that they don't have to keep paying out more claims and they can just keep collecting premiums.
Yeah, I love that response. Let's hear from Nia, and then I'll tell you a few of the things that I'm thinking about.
Hello, I am a third year actuarial science scholar at Florida A&M University, and I would say underwriting profit or investment income. So, like underwriting profit or loss, I would say like premiums or claims, and that's if like premiums are collected, claims paid plus operating costs and stuff like that.
Yeah, that's good. Paul, do you have another thought you want to chime in with?
I do. I was gonna say the research and like the data that we collect, and yeah, like UL Underwriter Laboratories.
Yeah, so I think you're harping on an attribute which is insurance companies tend to see an awful lot of certain very specific types of experiences, and they can generate data based on that. And there's a value to that data to a third party as well. But if we stick to sort of the standard approaches, I think all of you have touched on this idea of, you've got premiums coming in, paying for your product, and then you've got claims going out where things go wrong. So obviously, we're talking about um, what the insurance company will refer to as a loss ratio of trying to keep the premiums as high as possible and the losses, the claims, as low as possible. And that delta is that profit, that margin. Now, as I think Stefanos, commented, this could be our way to help our policyholders not have loss experiences by working with them proactively to help them be safe. For example, you run a bar, and behind your bar, it gets very wet and slippery at the end of the night. And periodically, your workers fall down or worse, slip and break an ankle. And then you're short a worker and you can't serve as many drinks the next night, and on and on and on. So why don't we buy a rubber mat for you so that your workers won't slip as much and you won't file that claim? That's a perfect example of how can we help make you safer proactively so that you won't tap your insurance product. And we'll be happy and you'll be happy because you'll have your workers doing what you want them to do, doing what they're supposed to be doing. So in my view, insurance companies make money two ways. Obviously, one is risk avoidance. And as we all know in our daily lives, there are certain things where your friend approaches you with an idea and you're like, that is crazy. We are definitely not doing that together. I don't want to be a part of that. I know as a parent, when I listen to ideas from my children, even at age 29, when they'll say certain things, I'm like, oh, I don't know if that's such a good idea. Um, so there are risks that insurance companies won't write, and we've sort of covered this idea of what do you do when you have a risk that an insurance company won't write? You might have to rethink whether or not that risk is really worth it. Um, and by the same token, I think insurance companies are very heavily engaged in pushing processes back to their policyholders to help them avoid a claim. It's in their best financial interest, and it makes the world safer in the process. Um, we should comment here that, loss events are growing much more severe. And in my company, we refer to this as the escalating trajectory of risk. It's not just that the cost of a life is worth more today than it was, particularly when you ask a jury that's deliberating on how much a settlement should be. The fact of the matter is that the causes of loss, um, the things that are causing that loss to occur, are coming from more situations than ever before. And as a result, the types of loss that you could incur are more varied than before. There's no question that the severity of a loss continues to increase. We're seeing that, in all sorts of settlement data. And at the same time, I think all of us would agree that no matter what metropolitan area you live in, you're seeing the billboards and the advertisements for personal injury lawyers. It's a thing. Injured on the job? Call us. We get you the best result for a slip and fall. We get you the plaintiff bar is very active because it's profitable for the plaintiff bar. As a result, they are fishing for more clients. And I have some auto liability insurers who will tell me that sometimes a personal injury lawyer is first on the accident scene before the emergency response crews, as everybody's listening to the same radio transmissions. The world is a little crazy in that regard. And the plaintiff bar is definitely driving up costs for insurers, making some experiences much more expensive. I would also tell you that there's a whole category of emerging risks, things that weren't a thing when I was growing up, but are now. And you start thinking about food additives, particularly food coloring and dyes, start thinking about microplastics and something called PFAS, which is, just thinking about the very tiny, hard to envision microscopic plastic particles that get into our bloodstreams and our brain cells. All of these things that might cause cancer in the future. Like, the world is becoming more complex because, back to where we started, human beings are constantly challenging the status quo. Now, why is that sort of a good thing for insurance in a wacky kind of way, at least in my oddball way of thinking? More types of risk mean more opportunities for insurance companies to decide whether or not this is a risk that they want to put on their books by accepting a certain amount of premium. And the other night I had dinner with the CEO who I'd worked for, who now runs a giant energy business. And he asked me, like, how is it going in the current economy for your business? And I'm like, it's amazing. And when I said that, he sort of grimaced and he smiled, because certainly in what I would call heavy industry, it's not always amazing, subject to what's going on in the current economic environment. If you simply look at the United States as the current topic du jour, there are all sorts of things going on with debates about tax rates and certainly tariffs, whether they're legal or not, by various court decisions and so on. And there's a lot of economic uncertainty. But what's not uncertain is whether or not a business can operate without insurance. That's not uncertain. A business must have insurance in order to really operate, as we've discussed. So the impetus to buy this product that hopefully nobody will use is strong. And what happens when parts to repair a car that are made in Canada or Mexico become more expensive due to tariffs or what have you? Then I would tell you that loss costs go up. But when loss costs go up, the insurers are remarkably adept at making sure that they maintain that margin between premium and claims, which means the next set of policyholders are going to pay more for this coverage because it's more expensive now to replace that car or to fix that car. Loss costs go up doesn't necessarily mean that insurers take it on the chin. It means that consumers might take it on the chin, but this is a product that's hard to avoid, as we've already discussed. And so for me, this entire industry becomes a preferred industry in my mind, because you have to have this product and you don't want to use it, which is really odd relative to other things out there. On top of that, when economic challenges come across that would make, the store that sells bicycles that are made in China, for example, and now those bicycles might be more expensive or not due to tariffs. Now I might have to, instead of expanding my bicycle store, I might have to, lay off a portion of my staff because I can't afford to buy the product and my customers can't afford to also buy my product from me. Those issues don't manifest themselves in the same way in the insurance industry. You must buy my product. you have to have it. And by the way, if it gets more costly for us to pool the risk, as we've discussed, I'm going to push that back to my policyholders. And I'm not suggesting that it's done with a sense of malice. I'm simply suggesting that if an insurance company can't be profitable, and I think this was either Gladys or Nia that made this comment earlier, if an insurance company can't be profitable, it can't do what it needs to do, which is to pool the risk successfully. The whole point of insurance is making sure that that insurance company can have your back when catastrophe strikes. That means the insurance company has to remain a going business concern as well. And the only way for that to happen is if the delta between premiums and claims is a positive one. If the insurance company is paying out more in claims than in premium, that insurance company won't be there to protect all of us tomorrow. So the insurance company must remain profitable, doesn't have a choice in order to be there for the next set of policyholders who step up and say, I have a risk, I have an exposure, I might have incur some liability here. Can you help protect me should something go wrong? But as we've said before, I don't want it to be that way. It's just in case. And so I think that's where I will leave you through my 10 basic bullet points. Jeff Cohen talking about the aspects of insurance that make this an industry unlike any other, and one where I think while we are chasing a profit like any business, we're doing it with an eye towards repair, replace, restore, and trying to make the world a better place, a safer place, a healthier place at the same time. And with that, I think I will take some comments from you before I tell you one or two other things. Thoughts, comments, questions, jokes. If you're on mute, I can't hear you.
Can I do it?
Yeah,
Please.
go ahead. Go ahead,
All right,
Stephanie.
perfect. I was very interested. I'm an undergraduate in economics. I'm going for an MS in enterprise risk management. So when you talked about third world nations and how their economies function, and you're saying that one big component of breaking out of being a third world nation into a prosperous nation is a thriving insurance market. I was curious, how would you say a third world nation can achieve, in your opinion, can achieve that environment to have a thriving insurance market?
It's a great question, Stefanos. I would tell you that it's not that different, at least in my take, from instances where you have to insure something ridiculously large, but previously it was small. And I'm going to use the example of aviation insurance to make my point. Let's just assume that you are getting your pilot's license in addition to your, undergraduate degree, what have you. And you decide to buy a small, two-seater, I don't know, I'm not a pilot, little propeller plane. And I assume tell the insurance company how often you plan to fly and what kind of distance and what types of conditions. And you promise never to fly at night and all the exclusions, conditions that the insurer puts on you. And you pay your premium and off you go. And hopefully never have an issue. Compare that to the experience of, say, United Airlines or Delta Airlines or American Airlines. And these entities are buying hundreds of giant 737s, what have you, all the time. And if something goes wrong, they don't want to just buy another plane for, I don't know, 70, 80 million dollars, however much a giant plane costs. So they have to build a tower of insurance because no insurance company wants to write a check for that full amount either. So instead, you get several insurance companies to layer upon each other. I'll take a portion of the risk, not the whole thing. I'll attach my contract onto your contract. And so I will underwrite the primary layer, call it 5 million, and there's somebody else that's 5x of 5. Now you have 10 million. Somebody else that's 5x of 10. Now you have 15 million. And several insurance companies all band together to underwrite your risk. I would suggest that third world country has to sort of approach it the same way. Let's build up beyond fruit stands and pizza stores or what have you. Let's get some investors up to here and find an insurance market that's willing to assume just that amount of risk, but not for the giant technological, pharmaceutical, oil refinery factory thing that we want to lure here next. That's my view. I see lots of hands. So I think Nia was next, but we'll rifle through.
Greetings. I am Nia Mason, a third-year actuarial science scholar at Florida A&M University. And I understand that risk pooling spreads the financial risk across many policyholders, but I love to hear how it's applied strategically within different lines of business, like health versus property insurance.
Well, I think that's probably my 202 lecture as opposed to my 101. And I think we would have to delve into, more specific elements of those segments of the marketplace in order to really, answer this question properly. Suffice it to say, Nia, that the beauty of insurance requires that the underwriter fully understand what makes that entity, whether it's health or anything else, unique from other things that are like it. So, if you're underwriting a utility business, you're not comparing it to a transportation business, you're comparing it to other things that are like it. And you have to decide as the underwriter whether or not that risk is a good risk or a bad risk. I would argue it's really a question of how much or how little do you like that risk. If that risk is a bad risk, there's a price for it. It's just a high premium. And if that risk is a good risk, there's a price for it too. That just might be a lower premium. And you're looking to put premium on your books at a price point that you can afford to backstop the underlying loss, regardless of the industry, the company size, the amount of revenue, the number of employees, blah, blah, blah. Let's go to Emma, who we haven't heard from yet.
Yep, and Emma did type in the chat, but if you're in a space where you can say hi, would love to hear from you, Emma.
Hi. Oh, I'm looking at the wrong camera. I just wanted to say that I've used Zywave a lot over my 3 years at an EV broker, and I love the platform, so I was excited to hear from you today.
I hope I didn't disappoint. Thanks very much for sharing. Paul, back to you.
I read the description of like the company through like the LinkedIn that was like shared with us. I was gonna ask, how does Zywave like help insurers proactively adapt to structural changes in risk, like climate change and cyber risk?
So I think your question is really like, what is the impact that Zywave is having on our customer base, our clients, in certain categories like climate and like cyber? I would first tell you that I think risks associated with Mother Nature are complex in a very different order of magnitude than, say, things that humans can control. When it comes to issues related to climate and Mother Nature, we are definitely shepherding through quite a bit of content and data. For example, how far is this business from a coastline? Or what are the right ways to shovel your sidewalk in front of your business after a snowstorm? There are a lot of things that have really strong, what I will call exposure implications to a business in terms of how loss could occur. And we are all about lowering those things for our customers and our customers' customers. When it comes to cyber, I think my response is expanded in a couple of different elements. Today Zywave is a trading platform by which capacity providers can actually trade with distributors like those retail brokers that Emma is working for. We have a variety of data on the subject. We probably have, some $100 billion of loss value that's tracked. So for a new capacity provider, how do you learn about things where you have no experience? You need data to do that. And we provide that data rather successfully to many types of insurance entities. So it somewhat depends upon the nature of the risk, if you're going to go climate versus cyber versus everything else. But in general, our overall approach is all about how do we help our customers, if they're carriers, underwrite more profitably? And if they are brokers, how do we help them sell more premium effectively, become better insurance agents for their clients? And I think we may be out of time. I'm just looking at Tandeka for a yes. So she's kicking me under the virtual table saying, hey, your time is up. So
Well, we do have one more hand that's up. If anyone needs to hop off, please feel free to do so. But I'm thinking we could address the last question that's up here from Gladys, and then we'll end the call. Go ahead, Gladys.
Okay, thank you. Thank you for everything you shared today. It was really eye-opening based on everything we are discussing about inflation, climate change, and loss, even growing in a more serve. My question is, do you think insurance companies are truly prepared for this increase in severity, especially as the risks evolve faster in the future?
well, I guess in order to answer that question, Gladys, I'd have to know a little bit more about the severity that you have your eye on. There are enormous what I would call catastrophic scenarios that haunt today's modern insurance marketplace. For example, imagine a cyber event where a hospital can't get patient data in a timely fashion. Imagine a water source that is, shall we say, breached, compromised. Imagine an electrical power grid that is turned off, and or the navigation for shipping that somehow is rendered useless. Like, all of these things would lead to catastrophic, multiple, that stone that hits the center of a pond and has lots of ripple effects going out. Think Bernie Madoff, think Deepwater Horizon, think these things that have 3 Mile Island, although none of you were around to see that, kind of thing. But the Mont Blanc tunnel collapse, like these real travesties. Yeah, I think the insurance industry is hyper focused on that. And that, by the way, is why insurance companies buy insurance, and that's called the reinsurance marketplace. Insurance carriers buy insurance for their businesses, and that's called reinsurance. And there's a whole nother segment that perhaps Tandeka will invite me back to talk about another time.
Absolutely. Jeff, you are welcome back anytime for the 202 series. We absolutely love to hear from you. Fantastic. So, thank you so much, Jeff, for being here with us today and hanging out with us for an hour. We truly appreciate it. For all of the students that are here with us today, as you know, we host these sessions on a weekly basis throughout the summer. So next week's session is going to be Thursday, June 5th from 1 to 2 Eastern. Our presenting company is going to be Munich Re, and our guest speakers are going to demystify the careers in actuarial science. So they're going to talk about reserving, pricing, and so much more. So thank you again, Jeff, for being here with us, for sharing all of this knowledge with us. We truly appreciate it. And for everyone else, I will catch you next week. Enjoy the rest of your day.
Thank you all.
Thank you.
Bye.